Welcome to Stock Charts Trading. Today we're going to be talking about harmonic patterns. And harmonic patterns have an impulse leg first, and then there's an ABCD pattern, which is basically a correction. And so that's one thing I hate about harmonic patterns, is it's just kind of declaring what a range box is, right? This motion back and forth between support and resistance, it only kind of confirms that little range, and we'll talk about that in a little bit. And so here we are on a bullish bat pattern, and you see it doesn't even come quite to the highs. It stays a little bit back below those highs, and then should fall off from there and go lower. So this is kind of a continuation pattern, but that's what we would expect with what an impulse leg down. Elliott wave is an impulse leg. And then what do you have after an Elliott wave? You have a correction, ABCD pattern. There's only two patterns, ABCD and Elliott wave. And so they've kind of taken this thing and say, well, we're going to make harmonics out of these consolidations, you know, where you got pennants and you got flags. And so it does help, but the thing I don't like about it is this variation. So basically they're saying right here you have a high. So if you came across that high here, you would have resistance. And so they're saying if you came across this low right here, that would be your support. And so then what they're saying is from this breakout, basically you're going to use a Fibonacci extension, and the first Fibonacci extension is the 127, and the next one is 140, and the next one is 160. And that's what I don't like about harmonic patterns, because basically I'm chasing the trade to enter. You know, is it going to be this one? Is it going to be this one? Is it going to be this one? Then what do I say if I say I'm going to only take the 1.6, and then what happens, right? It goes to 1.4 and falls off, right? You don't ever have the opportunity to get into the trade because it fell off before, because those lower Fibonacci levels were resistance, and basically traders took that trade. All right, so let's take a look at the chart. So right here we have a crab pattern, right? And so you come from the bottom, you go up to this impulse leg up, you put the Fibonacci extension, and what do you have? You have this box. And the reason you have this big, large box is because it's basically telling you there's opportunity to sell right here, or sell right here. And that's what's frustrating to me. Like, I want a true place where I can confirm that price will turn around and go the direction that I want. And then here, if we notice that in this trade, if I got in at the tippy top, this trade did not immediately work out, right? It did not come back down into this C support area. No, it stayed up and it went higher. And then even when it did break and come down, it took a long time before it got to where I needed it to go for me to make profits. So one simple way I diluted down taking these bad trades was I used support and resistance. So right here, I've got a high. I've got another high right over here. And so if I take that and I draw my line on over, what do I have? I have another high at resistance. And then what happens to price? That's right, it falls. And so that's what I'm saying. These fancy harmonic patterns show you false entry points. And so what is the real entry point? We know this. It is resistance. Higher highs, higher lows. All right, let's take this next one. We have a high right here. So we're going to put a Fibonacci on it. We go from the high down to the lows of that X leg. Sure enough, it goes right into this box, basically saying at any point in time, here, or here, it could turn. It goes lower than all of them and then makes the turn. And again, there's a solvable solution. So what do we have right here, right? We have this gap. We love gap supports. And so we start our line right here at the bottom of this gap. We come into this support level right here, which is a lower low. We then bring our line across the bottom here, which then also price comes down into, giving us these support levels, creating a wolf pattern right here, which is a buy signal for us to enter. What does price do? It comes right back to the old highs, and we have a target. So in both of these situations, if we just would have drew our support and resistance lines, we would have got in at a premium entry point with no guessing which Fibonacci level to take, nor with a miss entry point that gave us losses. Next, I want to talk about where and how to buy. So what did we talk about? We know two things, right? Elliott wave and ABCD patterns, which are pennants and all of that. So what we have here is a huge impulse leg. Now, what they're calling an impulse leg is from X to A. And then they're calling this little bit a pullback right here. And they're saying that this, which we know as a flag, is a harmonic pattern, which is our consolidation, right? So we have an impulse leg into consolidation. Once it breaks out of that consolidation, we should have another impulse leg. And then what happens? Consolidation. And right here we have consolidation, which shows us this pattern inside that consolidation. And then what do we have after consolidation? We have another impulse leg. And what do they show us? They show us this little pattern right in here, which is also consolidation back and forth off of these lows, and then the breakout. And so it works with what we do, right? We do impulse, consolidation. In consolidation, we wait for a support place or a resistance place to buy in for that impulse leg. We're trading for the impulse leg, not for the consolidation. And that's kind of what this trading does. They say buy here on the bottom of this D and take your profits when you come back into the highs. And so it's a very small trade. And not that you can't make money on it, but just looking at this chart, where would you rather buy? Would you rather buy at the bottom of the pink box and get out of the top pink box? Or look at these huge green lines on the chart that say increase, increase, increase. But when you're trading harmonics, you need to have a channel because you need to do what? Trend. What is the trend? And only trade harmonics with the trend, right? So why would you do a Gartley pattern or a bat pattern or any crab pattern, any of these other patterns, if you're not going the direction of the trend? Only if you were up against this resistance, which this does not give us a down trade pattern. If you were up against resistance, could you take a down trade? And that's what I want you to notice. When you go with the trend, then the harmonic patterns are much more favorable to work and make some serious profits. If you were not familiar that you broke out of this upward channel and you did not realize that you came up against this resistance area right here and that price was changing, going down, then you probably would have looked at this pattern right here and thought, oh, I can't wait to get in and ride this back up into this resistance area. The only thing you would have had was huge losses. But if you would have seen that you were in a down channel because you just broke out of the up channel, then this trade would have interested you at all. Saved money is made money. You might be asking, how do I make a channel? Well, here you are off of these lows here. You go upward and your line tool has a degree on it. And so right here is 35 degrees. And so you just draw it across there. We have a gap. And so then you come across your highs and there you are, your channel. Once you break that channel right here, what do? You're in a down channel. Grab your line tool, go to the top of these highs here and just bring it down and use that 35-degree angle to see where you should come into support and resistance. Take that and draw it down over. You have this gap right here and use that as your bottom. So you have an up channel, break down, and now you're into a down channel. What do you have? You have a pattern within this down channel showing you that it should fall off more right here at this gap fill, which is resistance. Price has no problem going down to old support and boom, you make the money. Maybe you add a stochastics. What do you have right here? You have a divergence right up into this resistance area with this bat pattern right here in a downtrend. All of these things combined giving you these awesome profits right here. All right, so what do we have? We have an uptrend right here. We have a break of that uptrend. So now what are we doing? We're going down. And so what do we see right here? We have the top, which is a high. We have another high. We have a lower high. price comes right up into that resistance area, what are we doing? We're looking to sell because we are in a downtrend. And so what happens? Price comes right past our target and boom, you make profits. Now you have a downtrend and you have to decide, are you going to do something at this double bottom right here? Is that the trade you're looking for? Or are you going to restrict yourself from taking every trade? And this is where it gets hard because you're like, man, look, it worked. I would have made a boatload of money if I would have entered into this trade. But I could show you just as many harmonic patterns that did not work up but went down. We've already looked at a couple. But what do we have right here? We have a bottom. We have a breakout. So now we know we're in an up channel. So what are we going to do? We're going to draw our line up and boom. Where does price come in? It comes in right here at support. And so this is a good tool to identify consolidation for what? More growth. And look at the growth because you were in the trend. Because you were in the trend, you were a go with trade, right? It was a continuation trade. And so this pattern worked great for that. Now what? You've got a break of your up channel. And so what do we anticipate? A down channel. And so we can come across this gap right here, coming around to these lows. We've got a down channel going. And what happens? We've got a pattern which says, hey, we want to take this down lower. So off this gap and this support level right here, we can duplicate that up from these highs over to these highs, which tell us that this is a good entry point. Using that same gap low and this low right here shows us that if we extend it out, we have some resistance right in here, which is a double confirmation. If we use these lows and we use these highs, we would see that we have another trend line confirming that price is not going to shoot up into this area, but we could take this trade to the down. And so where are your profits? Right here at these old lows, and you can see that price went down even further. When you use harmonic patterns by themselves, expect to have some losses. Add some rules to the harmonic patterns. Look for support. Look for resistance. Look for, if you have an indicator, not just that indicator, but a divergence on that indicator. And you will see that your trading will be a lot better because you have more knowledge about what's going on around you. Only trade the trend if you can help it, unless you have a lot of other confirmation saying, hey, this is going to be a counter trend trade. Because counter trend trades don't have as much movement as a trend continuation trade. Today we talked about harmonic patterns, and Fun with ThinkScript has a program that will do exactly what you saw today. It will print out the harmonic patterns for you. Here you go. It's typical candlesticks, but this thing works on Forex. It works on futures. It works on stocks. It prints automatically for you. It gives you the entry point, and then plus bonus, it gives you Fibonacci target places. But as we talked about before, you need to do a little bit more so that you can get that great advantage of being sure upon sure upon sure so that you can make lots of profits. Until next time.